Hi, my name is Steve Nomura. Today I'm going to talk about how you're going to make wealth in real estate investment business. We often use the acronym IDEAL. IDEAL means income, depreciation, equity, appreciation, and leverage. Those are five primary ways to make wealth in real estate investment business. First, I means income. Income is a core benefit of real estate investment business. We have two different type of income. If you buy some property for cheaper price and then put some money on fixing up and sell for the profit, this is the massive income. Another type of income is passive income. If you have rental properties, every month you're going to receive a rent from your tenant. That's the passive income. Passive income from rental property, massive income from flipping deals. You can wholesale or fixing, flipping, rehabbing to receive massive income. And second one is D. D means depreciation. You might think depreciation is a bad thing, but actually in the real estate, especially rental business, depreciation is not bad at all. In real estate, we have a huge tax benefit to have rental properties. US government allows us to tax write off using depreciation. Okay, if you buy properties, usually 70%, 80% is for the building. 20-30% is your land. Okay, then building part going to be depreciated over 27.5 years. Let's say you bought property for $120,000. $100,000 is for building, $20,000 is for land. This $100,000 can be depreciated over 27.5 years. You're gonna $100,000 gonna be divided by 27.5 years. It's about $3,640 or something. Every year you can take $3,640 or so as a tax write-off. Let's say you have $500 cash flow every month from the rental property, and 12 months that's gonna be $6,000. But you can take $3,640 from $6,000 rent profit. Means you're gonna have only $23,060 or so as your taxable income. In this way, because of this depreciation, you can save lots of tax payment of your rental income. Third one is E. E means equity, equity building or increase of the equity in the properties. Equity means the balance between the fair market value and the amount you owe. Fair market value of the property is $200,000. You owe to the bank or private lender for $150,000. Means you have a $50,000 equity in the property. Okay, equity building can be done in mainly two ways. Okay, if you owe the money to the bank or lenders, every month you're gonna pay them. Okay? If you pay $10,000 every year, you're making $10,000 equity every year. Or if you put some money and fix it, or you add some values, you completely replace the roof, or you put a new kitchen cabinet, or you put a new hardwood floor. Those kind of activity can increase the value, means you have more equity in the properties. Fourth one is A. A means appreciation. We have an inflation in the market. Things are going up. Price goes up every year. Same thing. If you keep your property nicely, if you do good maintenance activities, the value of your property will be also increased. It's called appreciation, natural appreciation. If you look at the last 50 years, the average appreciation ratio is like 6% Means if you bought a property for $100,000 as a fair market value, 10 years later, your property is going to be 1.5 times more. The value of your property is going to be 1.5 times, 1.6 times. That is the natural appreciation. Also, if you put some money to fix up or upgrade, let's say you change the entire roof, you put the new carpet, you put the new hardwood floor, you replace the entire bathroom or kitchen cabinet. Those kind of activity give the more value in your property. Means your property was appreciated. You have more value in your property. We talked about equity previously. Equity and appreciation go together very well. If you got the appreciation, you have more equity in your property. The last one, fifth one is L. L means leverage. This is very unique in real estate. Let's say you bought the property for $100,000 in cash. Then for 1 year, you receive $10,000 net income from your rental properties. In this case, you put $100,000 to purchase from your own pocket. You receive $10,000 net income, means your cash on cash return is 10%. But if you use leverage, let's say you put $10,000 as a down payment, you use other people's money, could be private lenders' money, hard money lenders' money, or bank money. You borrow $90,000 from those lenders. You get if you pay the loan payment every month, let's say you got the $5,000 net income. In this case, you put $10,000 from your own pocket, and you receive $5,000 net income. In this case, cash on cash return is 50%. If you use your own cash, your return is 10%. But if you use leverage and using other people's money, your cash on cash return is 50%. This is just example, but if you use leverage, your returns become much bigger. This is a very unique point in doing real estate investment business. We talked about IDEAL, ideal. Okay, those are 5 major ways to make wealth in real estate. If you are interested in getting more information, or if you have any questions, please leave your comment down below. Thank you.